Trading options for beginners. In this video, you're going to learn some basic terminology and definitions so that you can understand how to trade options. A lot of times in a lot of different industries, they'll use exclusionary jargon, such as with doctors and lawyers, and even as an investment banker, they will use definitions that will make other people feel confused or feel as if they don't know what's being talked about. When you learn how to trade options, you have to make sure that you understand a few basic definitions. About 80% of the money that I make from trading is by selling put options. Remember, when you sell an option, you are essentially the casino. When you buy options, you are acting as a gambler. Now, the casino doesn't make money. If 100 people come in, the casino doesn't make money from all 100 of those gamblers. Maybe the casino will lose money on 5 of them, but you make money on 95% of the people that enter your premises. If you make money as a stock, or rather as an options trader, on 95% of your trades, those are incredible statistical odds. So remember, we sell options, and about 80% of the money that I make is by selling put options. So what's a put? A put option obligates me, if I sell a put option, it obligates me to buy the underlying stock at a specific price. If I sell a call option, it obligates me to sell the underlying stock at a certain price. So for example, if Facebook is trading right now 175, I can sell a put on Facebook at a strike price of 160. Now what that means is if Facebook trades below $160 on the expiration date, then I will be forced to buy Facebook at $160. If Facebook is trading on the expiration date at 140, then I will be forced to purchase Facebook at 160. About 8 out of 10 times, Facebook will not drop below your strike price if you choose the correct strike price and also if you choose the correct expiration. That's why we always sell out of the money options. So again, you sell a put option. An example would be Facebook is trading at 175. You sell it with a strike price. Now, a strike price is your quote-unquote worry price. You don't really have to worry at all if when you sell a put, the underlying stock stays above your strike price, and you don't really have to worry that much if when you sell a call, your underlying your underlying stock stays below the call strike price. But really, you have to pay attention to making sure that when the underlying stock gets close to the put side or close to the call side, that's when you really have to start worrying and looking at the position. But for most of the trades, I would say probably 8 out of 10 of them, I just choose the correct strike price and the correct expiration date, and then I never have to look at it again. So again, remember, you're going to choose your strike price, which is the price that obligates you to buy if you sell a put, or the price that you're obligated to sell if you sell a call. And in exchange for agreeing to purchase when you sell a put or agreeing to sell when you sell a call, you receive money. This money is called premium, and it's also called you're taking in a credit. So by selling options, you are receiving money, and as a result, you are receiving a credit. If you buy options, which I don't know why you would, but some people do buy options, then they are going to pay a debit. As I mentioned earlier, the expiration date is the date at which the seller of the option is no longer obligated to guarantee that the underlying stock will not fall below that strike price. So, for example, if you look at it from an insurance perspective, if you buy a car insurance policy for 6 months and then you have an accident 2 weeks after the expiration of that policy, that policy writer, or rather the insurance company, is no longer liable for paying for that claim. Why? Because if it happened within the 6 months, then that person would be liable, or that company would be liable. But because it happened beyond the expiration date and the contract expired, then that person or that company is no longer obligated to make due on something that expired. So a good example of this, if we go back to the Facebook example where Facebook's trading at 175, if we sell a put with a strike price of 160, I can have the expiration be 3 weeks, and then I could receive, let's say, $1. Or if I choose an expiration that is 6 weeks out, which means that I'm obligated for an incremental or an extra 3 weeks to buy Facebook at $160, if it were to fall below that on the expiration date, then I would receive more money. So instead of receiving $1 like I would for the 3-week option, I'd probably receive around $2.20 for the 6-week expiration. An underlying asset, that's simply the stock that you sell the option on. So this includes something like Facebook or Amazon or Google or Netflix or Tesla or Nvidia. So all of these very large companies, they have a liquid options market, which means that there's a very deep market. It's very easy for you to sell options on something like Facebook because it's worth about $500 billion. And you want to deal with markets where there's a lot of activity and a lot of liquidity, because that means that the pricing is much more efficient. So the underlying stock, you can sell contracts, and that's what you're going to sell. You're going to sell one contract, let's say a one put contract on Facebook. One contract is 100 shares. So going back to the Facebook example, you can sell one contract with a strike price of 160 and an expiration date of August 20th, and you can receive premium of $1. So as a result, we are permitting ourselves or forcing ourselves to buy Facebook if it drops from its current price of 175. If it drops below that and it drops below 160, we will force ourselves to buy Facebook at 160 as long as it's trading below that price, $160, on August 20th. If it stays above $160 on August 20th, then we collect the full amount of premium, which we receive is $1 per share. So if you sell one contract and you receive $1 per share, then you receive $100 for making that trade. If you sell 5 contracts, that obligates you to buy Facebook. In the example that we used before, you sell 5 contracts, you're obligated to buy Facebook, to buy 500 shares of Facebook at a price of $160, and in return, at $1 a share, you will receive $500 for making that trade, and you will make that money with about a 90 to 95% probability. A few other definitions: buying power really just means the number of contracts that you can sell. So if your account has $30,000 in it, then you can control $60,000 worth of stock. And because options, the regulations are a little bit different, you actually have greater leverage. So you can control $60,000 worth of stock, and you can probably control about $150,000 worth of options. So options, they reduce buying power at 20%, whereas stock reduces your buying power at 50%. But for all intents and purposes, buying power is just the number of contracts that you can sell. A vertical credit spread means that, using the Facebook example, I would sell the 160 and then I would buy the 150 put. It would have the same expiration, the same underlying, so Facebook, and it would be the same type of option. Remember, there's only 2 types of options, puts and calls. So if you wanted to do the trade that we spoke about before, you would sell one contract of Facebook with a strike price of 160, an expiration of August 20th, and you would receive $1. If you wanted to turn that into a vertical credit spread, you can do that same trade where you choose the 160 strike that you're selling, and then you can buy the 150. And then the reason that people use vertical credit spread is it allows you to sell and control more contracts. So it leads to a more efficient usage of your buying power, because instead of Facebook having a maximum risk of $160 a share, if you were on the hook and had to buy Facebook at 160 and then Facebook went bankrupt at $0, you would still have to buy Facebook at 160. But if you sold a vertical credit spread with 160 you sold and the 150 that you bought, then technically you would only have to, your maximum loss would only be $10. A few other things: bid and the ask. You're going to buy at the bid, and the ask is the maximum price that you can sell at. Usually, I would say 95% of the trades they get filled at the mid price. So going back to that $160 Facebook put, if it gets filled at $1, the bid is probably going to be like 95 cents, and the ask is going to be $1.05, and then they're going to meet in the middle, and that trade is going to fill at $1 a share or $100 per contract. A limit order. When you enter your trades, you should always use limit orders. A limit order is simply the minimum amount of money that you're willing to receive in order to execute that trade. So going back to the Facebook example, if you set your limit order at $1, that means that the minimum amount that you are willing to accept is $1 per share or $100 per contract, and the exchange cannot fill that order unless you receive at least $1 per share or $100 per contract. And roll or manage, that's the last definition. That I typically have to roll or manage a position about 5 out of 100 times. And what that pretty much means is that I would close out the trade that is problematic, and then I would just extend in time, extend duration. So instead of like using the example that we used before, let's say the August 20th put, let's say it was August 10th, and that put option that I sold expires on August 20th. I could then buy back the August 20th with a strike price of 160, push it forward into September, sell 155 strike price put, so I would get $5, and I would still be able to bring in a small amount of credit. Or you can roll it forward from August to September and keep the strike price the same at 160, and you would be able to collect even more credit. So remember that when you sell options, the probabilities are in your favor, and you are acting as a casino, because an asset, just like an insurance policy, is a depreciating asset that with time eventually goes down and is worthless. So that's why we make money. Every single day that goes by where stock prices don't move, or if they move in my favor, I profit from the time decay, because an option is an expiring asset, and I also make money as the underlying stock moves further away from my strike price. And to be honest, when you do something where you sell the $160 put, if Facebook is trading at 175, you have a $15 cushion. So I don't even care if Facebook drops all the way down to 162 or 160, or 161. As long as it stays above 160 on my expiration date, then I make money. So a quick summary, because I know that was a lot of information, and to be honest, I gave you about, I'd say 10 or 12 definitions. Of them, the most important things to learn and to take away are that you always want to sell options, you never want to buy. About 80% of the money is made by selling put options. A put option obligates you to purchase the underlying stock, such as Facebook, at a specific strike price. Options are expiring assets that don't have any value. So, for example, if the underlying stock trades above your strike price on the expiration date, then you keep the entire amount of premium. The only time that the option that you sell has any value is if, any intrinsic value rather, at expiration date, is if the option that you sold is trading below the strike price. So in this example, at the expiration date, if Facebook is trading at 165, then that option that you sold, that you collected $1 per share, is worth nothing. If Facebook is trading at 155, though, that means it would have to have fallen $20, or around almost 15%. Then in that instance, if it was trading at 155, then that option would be worth $5. But you already received $1, so you would be out $4. So remember, you sell options. It's the only way to make money. You want to be the casino. You don't want to be the sucker. You don't want to be the gambler. 80% of the money is going to be generated by selling puts. And for all the other like technical information, I would not focus on overwhelming yourself, because the most important aspect is just to get started. If you want more informational videos like this, you can go to BestStockStrategy.com and you can receive $400 worth of free training. And if you want to instantly become a successful and profitable trader, then you can sign up for my trade alerts. It's only $19 for a 7-day trial. And that's the fastest way that you could possibly do by simply copying one of the best traders in the world and then putting the trades on for yourself. Once again, this is David Jaffe with BestStockStrategy.com. And if you have any questions, make sure that you subscribe. You click the little bell in the bottom right corner. That way you can receive alerts once I put out a new video. You can share this with your friends. And if you have any questions, leave a comment below and I'll be sure to answer it. Thank you.